Hey, it's Darius Clark of I-75. And if you know me, it's probably from CPA Review. But did you know that I-75 now offers EA Review? All three parts of the enrolled agent exam. You can get a three-part bundle or separate parts. And the best part is we now offer a scholarship to not only the CPA Review, but also the EA Review. So when you click on frequently asked questions and then the scholarship page, scroll down and click on enrolled agent exam if that's the one that you want to apply for. Apply today and you can win a scholarship to all three parts of the enrolled agent exam or whatever part you need. Just go to cpaexamtutoring.com. And now let's look at today's video. And in this video, we're going to talk about rental income. Because on the exam, if your client is a landlord, they're going to fill out Schedule E. Notice how the gross rentals are on line 3, rents received $24,000, and then everything down here under expenses is what we're trying to deduct for the current year. While the gross income is $24,000, that's the total rents received, after all the deductions, what's going to be taxable is the net rental income, and that happens to be just $1,228 after deductions for things like depreciation on line 18, taxes on line 16. Now, you don't have to memorize line numbers, but you have to know what's deductible. So let's take a look at some multiple choice questions on rental real estate and deductions that you should be ready for. Net rental income on Schedule E of Form 1040 is generally considered to be income subject to the self-employment tax? No. Schedule E rental income is not typically subject to the self-employment tax because it's not considered earned income, it's considered passive income. Rental income is considered passive. How about B? Is net rental income on Schedule E considered income for purposes of calculating the earned income credit? No. For the earned income credit, you got to have income from wages, salaries, tips, a partnership, an S corporation. Rental income is not considered earned income, it's considered passive income, so neither of these are correct statement about net rental income. Carla owns a rental property. Which of the following costs can be deducted in the current year rather than depreciated? So when you're a landlord and you're spending a lot of money on maintenance and repairs, certain things have to be capitalized, which means you can't get an immediate deduction. If something adds a lot of value to the property, that has to be capitalized, especially if it's a bigger ticket item. But you could get an immediate deduction for something like changing a light bulb or something that doesn't add much value, like replacing a shower curtain. So let's look at these choices. She wants to get an immediate deduction. She replaced the heating system in letter A. That's going to add tremendous value. You go from having an old heating system to a new one, you're going to have to capitalize that. B, built a detached 2-car garage. That's going to add tremendous value. That's going to be capitalized. Can't get an immediate deduction for that. So A and B are out, then D must be out. C says replaced a screen in a window. Yeah, that would be like changing a light bulb. So you could get an immediate deduction for that. So capitalize and depreciate what adds value to the home, deduct immediately what does not add any new value, but just replaces the value that was there, and replacing a screen in a window would be a good example of that. So we'll go with C. Theo enters into an agreement to lease a house to Pia. Although the fair rental of the house is $10,000 per year, Pia is required to pay only $7,500 per year in return for building a sunroom onto the premises, which will be left on the premises at the end of the lease. The lease is to last for 2 years. Pia finishes the sunroom in the first year of the lease. How much rental income does Theo recognize from this transaction in the first year of the lease? And the answer is $12,500 is recognized as rent in the first year, because rents are taxable in the year received, whether they're received in cash, property like a sunroom, or as services. Well, since the fair value of the rental is $10,000 per year, and Pia only pays $7,500 in cash each year, that's how you know the improvements in lieu of rent are $2,500. $2,500 in the first year and $2,500 in the second year. Improvements, though, in lieu of rent are included in the lessor's income when the improvements are completed, the same as if cash rent had been received at that time. So the entire improvement of $5,000 will impact year one of the lease only, since all the improvements were completed in year one. Now, since Pia paid $7,500 in cash in the first year and completed the improvements in the first year, Theo must recognize $2,500 plus $2,500 plus $7,500, or $12,500 of rental income in the first year. Note that in the second year of the lease, only $7,500 is recognized as rental income. Lance rented out his summer home for 70 days and used it personally for 30 days. He paid $1,000 for repairs and $2,000 for utilities. Rental income was $9,000. How much was net rental income? Well, since the property was used for personal purposes for more than 14 days, then the property is considered a vacation home, and expenses are limited to gross income. Expenses must be allocated between personal use and rental use based on the number of days of use of each. Now, it looks like Lance rented the home out for 70% of the time. 70 days rented divided by 100 total days used. Therefore, the $9,000 in rental income minus the $3,000 of expenses equals $6,000, then multiply by the 70% rental use, and the net rental income is $4,200, which is letter A. Don't forget to apply for an I-75 scholarship. Go to CPAExamTutoring.com, frequently asked questions, click on scholarship, and then choose either the CPA review or EA.